Hey, this is Sasha. Thanks for joining me in today's video. And what we're going to share today in this episode is why getting assigned on your option contracts can be a great and wonderful thing. Stay tuned. I'm going to share with you some insight in this video. All right, so a lot of people that trade option contracts, we worry oftentimes. I get emails about this thing where assignment is a big risk factor for many people. They get worried about getting assigned because they haven't had it happen to them first off. Or let's just say you're trading, $500 worth of options and now you could get assigned $50,000 worth of stock. And that can be nerve-wracking for some people. All of a sudden they feel that they have all these nerves going through them that, hey, this could be a really bad thing. And I'm going to share with you in this video why it's really not as bad as you think, and maybe lighten up your ease of mind and peace and calm things down. Okay, so before we get started, I do want to remind you that we have a lot of great things on our website. So check out the website at tradersfly.com. There's a lot of great getting started pages. That's where you should start. Options Trading 101. Go there, scroll down also, join the newsletter list, and that's where we send out other great notifications. Check out some courses at our other website, Rise to Learn. That's where we have all our courses, a lot of great courses there, membership site as well, and coaching. So those are some great resources for you to get started if you really want to ramp and speed things up. Otherwise, you could hop around on a lot of the free YouTube videos that we offer. Anyways, I want to show you some thoughts regarding option contracts and getting assignments. So let's take a look at, let's say I got McDonald's, Netflix. It doesn't really matter what kind of the stock that you're dealing with or trading. But let's say you're dealing with a stock or situation, and let me just put on Facebook here real quick. And we're looking at contracts right here, and we're looking at basically setting up maybe a diagonal spread. And if you look at diagonal spread, butterfly spread, anytime you're kind of short contracts, you have the possibility of getting assigned. And a lot of people worry because what's happening is that you might go ahead and put on a position, or, let's just say you go ahead and buy a calendar here for the put side. And here you might go ahead and you've got this scenario and situation. Let me go ahead and just do the calendar here. And here we've got our calendar. And let's say this does go in your favor. And then all of a sudden it keeps going past your favor. And, and the stock moves down, 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 and you make a little bit of money on it, but you also get assigned. So basically price continues to move, 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 and you're below that short strike. And all of a sudden you get assigned, and people get worried about that. And I know that if you don't do something very often, and if it doesn't happen often enough, those are the times when people get worried. And here's what I want to share with you is when you go and look at these things, remember what happens during assignment. During assignment, you have that intrinsic and extrinsic value. So let me go ahead and show you this. Here's intrinsic, and we'll change it to extrinsic here. So as we look to this value, you have intrinsic, which are out of the money, and extrinsic. So think of this as kind of like time value or value that's outside of actually worth anything. Once you get into these contracts being intrinsic value, they actually have some sort of value to them, some tangible physical kind of value. You could do something with it, right? But what happens is that when you look at these contracts, and let's say you're dealing with assignment, and we've got these contracts, and let's say we are short, and we had like a -1 over here. Well, what's happening, and let me just go to this other position so you might be able to see it. What's happening is that when somebody assigns you the contract value, what they're doing is they're taking this extrinsic value, no matter if it's a call or put side, they're taking this value basically to zero. Okay, so they're taking that extrinsic value, that time premium, all the way to zero right away. Boom. So think about it like this. If you're selling a contract, whether it's a call or put, let's say I'm selling a single put right here, and I go ahead and I sell it. And let me just go to this account so you can see it. If I'm selling this contract and I got assigned right away, immediately, right now, what does that mean? Well, remember, I'm selling this put. That means somebody can put that stock to me. They can put it to me. And if I got assigned immediately, not that I would right now because, we're kind of out of the money right here. But let's say I did, hypothetically. I would make $905 of time premium right away. So is that a good thing? Yeah, because I don't have to wait a full 30 days to collect my time premium. So as you get into assignment and as you get into assignment risk situation, you're basically going to take this time value, that extrinsic value, as you look at, let's say, 31 days, you can see there's some kind of extrinsic value. Let's go to the 3 days. You can see there's not as much extrinsic value. Maybe at the money there is. But what that happens is that when you have, here's the 3 days. Let's go to just one strike here. I just want to open these up for you so you can see. And you can compare. So look at the extrinsic value that goes on here, okay? So you've got time premium that basically is here, 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 at these different points. I guess this one is that one, and here. So when you get assigned, that extrinsic value goes to 0. And that's a good thing, because when that happens, you basically go ahead and say, okay, fine, I'll take that assignment. Now, yes, it maybe costs you a little bit extra for the assignment, maybe $10 in commissions, $20, depending on the brokerage. But then what you do is you go ahead and you take those shares and then you go ahead and dump them back in the market. So you get assigned, and then the broker, even if you don't have the cash, let's say, hey, you got to dump those shares. So then you'll go ahead and resell those back into the market. But at least you've gotten all this extra time premium without having to wait. So if you got assigned, let's say 30 days early, well, those people basically just took that early and went ahead and took your time premium to 0, meaning they've given you free premium. Now, this is really only if you kind of set up your spreads the proper way or the right approach. So let's say I went ahead and did a diagonal here. And if I did a diagonal and I sold, let's say, a 200 and a 235, so I'm out of the money, okay? And I did kind of a diagonal where I am bearish right here, as you can see. Even if I go, let's say 220 right here, 240, maybe even a 230. So I've gotten this diagonal setup right here, and I'm making money as the stock price heads lower. Well, let's say this continues to tank, continues to move lower. Could you still get assigned? Yeah, absolutely you can, because of the short that would be in the money, because you'll be -1 at 230. So you'll be -1 right there. So you could still get assigned, but remember what's going to happen. If you get assigned 5 or 10 days early, well, ultimately that could be a really good thing, because that time premium goes right away to 0. So even though a lot of times what people do is they go here, okay, and then you still have that time premium left, right? So what's going to happen is you might only be up $365 out of 509. Well, all of a sudden, the person that does the assignment, they say, hey, I want to get, I want to take that assignment. It could be due to a stupid reason. They might not, they might just need to do it. They're obligated to do it. For whatever the case and point is they go ahead and they decide to exercise something, and they want to cash in on that. And you get that extra, basically, $150 or so of time premium without waiting those extra days. So when you get that assignment, okay, you take your 100 shares, whatever, dump them in the market, and then go ahead and do the same thing over and over again. So that's what I want to share with you, is that it's not as big of a deal that people make out to be as far as getting assigned, especially if you're setting things up correctly. Because if things go in your favor like this, right, you set up a diagonal spread, you're bearish, and then it continues to go, and let's say you're a huge winner, can you still get assigned? Yeah, absolutely. Especially if you're like 2 days, 1 day away from expiration. Yeah, you could still get assigned, but it's not the end of the world. It's not a big thing, because you've set up your spread correctly and properly. But all they do is they take that time premium to 0, which means you collect your full 100% from the time premium. You take those shares, you dump them back in the market, because why would you go ahead and take a $600 trade and turn it into maybe a $60,000 trade? No, you just take that assignment, boom, dump it back, and that's it, and close out your other position, your other along, and that's it. That's the way that it would work, and that's why it's not as bad as people think. So don't let it scare you if you're setting things up the right way. Now, some people, they go ahead and set things up the wrong way, and what they do is they go ahead and, let's say, start selling time premium like way over here, deep in the money. maybe it'll be here, maybe it'll be somewhere deep in the money over here. And when that, when that extrinsic value gets, I don't know, maybe 10 cents, 20 cents, under a buck, you need to start to worry. Now that usually happens maybe more close to, let's say a few days before expiration, because even here you could see that you've got time premium of 80 cents because people want to cash in their time premium. But if you go further out duration, let's say 31 days, that time premium is still fairly juicy, right? So people aren't going to cash in because they've bought that as insurance contracts, and they want to go ahead and, hey, if I've already bought it, I'm going to hold on to that insurance, or I'll just resell the insurance premium and contracts. So rather than exercising my right. So anyways, that's some insight for you on assignment risk and why it's not as bad. Definitely, if you want a little more insight on it, go ahead and join the newsletter list. We do some live events here and there. We also go ahead and have some insights on courses, membership stuff, and much more on coaching. And that's really where you'll get a lot more learning and insight. And all of that is at tradersfly.com. And if you're looking at courses and classes, we're at learn.com. All right, so thanks again. And remember to check out some other great freebies that we have on the website that you can download. You can also subscribe to the YouTube channel if you're brand new. Thanks again, and I will see you next time.